They told you the market is efficient, that every price reflects all known information, that the smart people, the fast people, the hedge funds, the quants, the bots, the interns surviving on cold brew and trauma have already priced in everything. So if that's true, let me ask you a dangerous question. Why does mispricing keep showing up like a raccoon in a five-star hotel? Because here's the great paradox of finance. The market is often efficient, but never perfectly efficient. And that tiny crack between price and value is where fortunes, mistakes, and legends are made. Tonight, we go down the rabbit hole. What market efficiency actually means, why fully priced is often an illusion, and how real edges still exist, even when it feels like the whole world is staring at the same chart. And no, your edge is not, "My cousin said this coin is going to the moon." That is not an edge. That is a cry for help. Let's start with the doctrine. The efficient market hypothesis, or EMH, says asset prices reflect available information so well that consistently beating the market on a risk-adjusted basis is extremely difficult. That's the core idea behind why passive investing became such a dominant philosophy. In plain English, if news is public, the market should already know it. If everyone knows it, it should already be in the price. And if it's already in the price, showing up late with breaking news is like bringing an umbrella to last week's rainstorm. This is why so many professionals say, "You're not smarter than the market," which is a very polite way of saying, "Please stop revenge trading after watching 3 motivational reels and 1 candlestick tutorial." But here's the twist. Even the theory of efficient markets has a built-in crack. Economists Sanford Grossman and Joseph Stiglitz argued that markets cannot be perfectly informationally efficient because if prices fully reflected all information, nobody would have any reason to spend money gathering information in the first place. And if nobody gathers information, prices stop being fully informative. That's not a footnote. That's the whole game. Perfect efficiency would destroy the incentive to create efficiency. In other words, the market can be very smart, but it can never afford to be omniscient. What efficient really means? When people say the market is efficient, they often say it like a religious chant, but finance is more precise than that. There are different versions of efficiency. Weak form efficiency. Past prices alone shouldn't give you a reliable edge. So if your strategy is just, "This line went up, so line go up more," congratulations, you have rediscovered optimism. Semi-strong efficiency. All public information is already reflected quickly in prices. Earnings reports, guidance, macro headlines, analyst notes, public filings, absorbed fast. Strong form efficiency. Even private or insider information would already be reflected in prices. That version is the extreme one, and also the one reality tends to laugh at. So when markets feel fully priced, what people usually mean is this. Obvious information is widely known. Obvious trades are crowded. Obvious opportunities have been competed away. That part is mostly true. The easy money, the cartoonishly obvious money, is usually gone. But not obvious is not the same as not real. And this is where amateurs and professionals split apart. Amateurs look for free money. Professionals look for misunderstood probability. That difference is everything. Why mispricing still exists? If markets are competitive, why does mispricing survive at all? Because markets are not one giant brain. They are millions of brains, mandates, fears, deadlines, incentives, and occasionally panic in dress shoes. Mispricing survives for 5 big reasons. 1. Information may be public but not fully processed. Everyone can see the data. Very few people interpret it correctly. A company releases earnings. One crowd sees a revenue miss. Another sees expanding margins, improved cash conversion, and a temporary inventory issue that disappears in 2 quarters. Same facts, different conclusions. Markets are fast at absorbing simple information. They are much slower at absorbing complex information. That is one source of edge. Humans are not spreadsheets. Fear, greed, overreaction, hurting, these are not bugs in markets. They are features of markets because markets are made of humans. Even when bots are trading, humans still designed the bots, which means the irrationality is now automated at scale. Beautiful. Institutions have constraints. A fund may know something is cheap and still be unable to buy it. Why? It's too small, too illiquid, outside their mandate, too volatile for client optics, too ugly for the quarterly letter they'll pretend investors read. So the asset can stay mispriced because the people who see it cannot or will not act. Arbitrage is limited. Textbook arbitrage sounds magical. No risk, no capital, instant profit. Real arbitrage is uglier. It usually requires capital, can stay wrong longer than you expect, and can blow up your career before it proves you right. That's the core insight behind the limits to arbitrage literature. Translation: you can be right and still get carried out of the building in a cardboard box. Attention is scarce. The market does not price everything equally well. It prices what people are watching. Large, famous, heavily covered assets, usually tighter. Messy, boring, small, complex, inconvenient, or unloved assets, that's where attention gaps live, and attention gaps create pricing gaps. Wall Street will spend 10,000 hours debating a trillion-dollar megacap. Meanwhile, a weird little cash-generating business in a dull sector gets ignored because it has no charisma, no hype, and the CEO sounds like a regional accountant, which, by the way, is exactly how some of the best opportunities dress. The big lie about edge. Now let's kill a myth. Most people think an edge means secret information. It usually doesn't. For most legal, rational investors, edge comes from one of four things: a better interpretation, not faster news, better judgment. You're not first to the headline, you're first to understand what matters. A longer time horizon. This is one of the most underrated edges in all investing. Markets often price the next quarter obsessively and the next 5 years lazily. If everyone is fixated on next week, patience becomes an informational advantage. Time itself becomes your moat. Better emotional control. A shocking number of poor decisions are just emotional decisions wearing business clothes. When others panic, dump, chase, or freeze, the disciplined investor gains edge by simply not losing their mind, which sounds basic until money is on fire. Superior process. A repeatable framework beats vibes. If your investment process is, the chart looked sexy, that is not analysis. That is financial speed dating. A real edge is systematic. What do I know? What is consensus? What is misread? What must happen for value to converge with price? What could make me wrong? How long can I wait? That is where adult investing begins. So where do you actually look when markets feel fully priced? Not in the loudest place, usually in the least comfortable one. Here are 5 classic hunting grounds. Complexity. If something takes real work to understand, fewer people will understand it. Conglomerates, spin-offs, regulatory overhangs, messy financial statements, temporary accounting distortions, cyclicals at turning points. When the story is complicated, the market often simplifies badly. That simplification can create mispricing. Forced selling. Sometimes people sell not because something is bad, but because they must. Index deletions, redemptions, margin calls, fund liquidations, mandate changes, tax loss selling. That's not value discovery. That's a fire drill, and fire drills can create temporary discounts. Narrative distortion. Some assets are overpriced because the story is too beautiful. Others are underpriced because the story is too ugly. Markets love clean narratives. AI will change everything. Retail is dead. This sector is finished. This company is the future. Maybe, maybe not. Narratives compress nuance, and whenever nuance gets crushed, price can drift away from value. Small, ignored corners. The more covered an asset is, the more competition there is for insight. That doesn't mean large assets can't be mispriced. It means obscure areas may offer more room for differentiated work, especially where fewer institutions can participate due to liquidity or mandate constraints. And time mismatch. The market often overreacts to short-term pain and underreacts to long-term change. A company misses one quarter, the price gets punished like it keyed the market's car. But if the long-term economics are intact or even improving, the short-term drama may be mispricing, not truth. This is where patient capital eats, quietly, like a lion with a spreadsheet. How to test whether it's a real edge or just ego. Now here's the dangerous part. A lot of people don't have an edge, they have a theory. And a theory without disconfirming discipline is just expensive imagination. So before you act, run the edge test.
Question 1. What is the market assuming? If you can't state the consensus clearly, you're shadowboxing. You need to know what is already priced in. Question 2. What is specifically mispriced? Not this stock is undervalued. That's not specific. That's flirting. Be precise. Growth expectations too low? Margins too high? Asset value ignored? Balance sheet misunderstood? Duration misread? Risk overstated? Name the gap. Question 3. Why does this mispricing exist? If you can't explain why others are wrong, assume you might be the one auditioning for that role. The best mispricing thesis includes a mechanism, complexity, forced flows, behavioral overreaction, institutional constraint, attention gap. Question 4. What is the catalyst, or must there even be one? Some value unlocks via event, earnings,
Spin-off, buyback, refinancing, legal resolution. Other times, the catalyst is just time and compounding. Know which game you're playing. Question 5. What would prove you wrong? If your thesis has no kill switch, it's not a thesis. It's a hostage situation. Real investors define invalidation in advance. The deepest rabbit hole. The market is efficient relative to who? Here's the deepest layer. Market efficiency is not a single on-off switch. It's relative. The market may be highly efficient for the average person and still inefficient for the specialist. That means, for most people, broad, low-cost indexing is still a rational default because consistently generating alpha is hard and costly. For the highly disciplined, deeply prepared, emotionally stable investor with a real process, edges can still exist because perfection is impossible and arbitrage is constrained. Both statements can be true. That's what makes this topic so fascinating. The market is not a slot machine. It is not a cheat code. It is not a morality test. It is a battlefield of probabilities where competition removes the obvious and rewards the specific. And the more fully priced everything feels, the more your edge shifts away from prediction and toward better framing, better patience, better filtering, better emotional discipline, better understanding of where everyone else cannot or will not look. In mature markets, edge becomes less about brilliance and more about being slightly more right, slightly more often, for slightly longer, which is much less glamorous and much more profitable. So, can you find edges in a market that feels fully priced? Yes, but not by assuming the market is stupid, and not by assuming you're the chosen one because you drew a triangle on a chart at 2 a.m. You find edges by respecting this truth. Prices move fast, understanding moves slower. And in that delay, between information and interpretation, between panic and patience, between crowd consensus and actual value, mispricing lives. Not everywhere, not always, but enough. Enough for the prepared, enough for the patient, enough for the ones who know that efficient does not mean perfect. It just means the game is hard, and hard games still have winners.